India's government has taken 29 distinct, overlapping labor laws and compressed them into 4 new streamlined labor codes. This comparison table from the official documentation shows the sheer scale of the reduction. We see 29 central acts distilled down to just 4 codes, with total mandatory forms dropping from 181 to 73. Politicians market this as ease of doing business. But for private limited companies, stripping away paperwork also strips away the administrative ambiguity that historically allowed for loose financial structuring. The anchor of this new regulatory framework is the Code on Wages, 2019. While passed at the federal level, its precise financial requirements are now being actively enforced through state-specific notifications. Fewer forms do not equal cheaper operations. With consolidated reporting and single electronic returns, structural noncompliance in your payroll is now entirely visible to regulators. For decades, the standard corporate approach to the cost to company, or CTC, relied on minimizing the basic pay. Companies would then stack the rest of the package with allowances like HRA, LTA, and specialized reimbursements. The math behind this was simple. Statutory liabilities like Provident Fund and Gratuity are calculated as a percentage of basic pay. Keeping the base low kept the employer's mandatory out-of-pocket costs low. The 2019 Wage Code explicitly targets this exact compensation strategy, rendering the allowance-heavy CTC illegal. To remain compliant, founders must execute 3 specific transitions: restructuring the central wage definition, calculating against rigid state-level cash floors, and mapping new timelines for exits. Ignoring these phases transitions a company's risk profile from minor administrative penalties into continuous, compounding financial liabilities. The structural pivot relies on Section 2 of the Code, which enforces a strict, unalterable definition of what constitutes a wage. Under this code, wages are strictly limited to basic pay, dearness allowance, and retaining allowance. The defining mechanism here is the 50% rule. The law places a hard mathematical ceiling on everything else in the compensation package. All exclusions, whether it's house rent allowance, performance bonuses, or internet stipends, cannot legally exceed half of the employee's total remuneration. If those allowances do cross the 50% threshold, the law steps in. The excess amount is automatically reclassified and added back into the core wages bucket. This forced expansion of the basic wage breaks historical financial forecasting models. Immediately, the employer's matching contribution to the Provident Fund increases, as it is now calculated against a legally inflated base. Over the long term, this identical inflated base is used to calculate gratuity, creating a massive unfunded liability on the balance sheet. The 50% rule guarantees that companies can no longer design around minimum statutory contributions. It mathematically forces up the baseline operating cost for every employee on the roster. While the central code defines the 50% ratio, the actual financial hit is determined by individual state governments. We can see this exact execution in the recent Telangana state minimum wages notification. State gazettes dictate the absolute minimum cash floor for that basic wage, locking employers into a rigid classification system. This specific table from the Telangana notification demonstrates the 2-axis matrix states use to fix monthly wages. The x-axis defines geographical zones. Operating a business and a municipal corporation, like a major tech hub, automatically locks you into the most expensive bracket, Zone 1. The y-axis categorizes skill. A highly skilled worker in Zone 1 demands a strict baseline wage, mapped here at 20,000 rupees. Founders often assume these rigid minimum wage matrices only apply to manufacturing plants or heavy industrial laborers. But this excerpt from Schedule 1 of the notification proves otherwise. The government has explicitly added modern service sectors, capturing e-commerce, courier services, and tech-adjacent roles directly in this matrix. Sitting on top of this matrix is the Variable Dearness Allowance, or VDA. The VDA links mandatory pay increases to the Consumer Price Index. This forces companies to implement biannual wage hikes to match inflation, completely independent of the company's revenue or individual employee performance. Between the state dictating the absolute minimum cash value and the central code mandating the 50% allowance ratio, modern companies have zero legal room to creatively underpay their workforce. This strict, rigid structure culminates in the absolute final stage of the employee lifecycle, the offboarding process. Historically, HR and finance departments relied on a 45 to 90-day window to process full and final settlements, utilizing that buffer for cash flow management. This section of the Wage Code eliminates that buffer. Section 17 dictates that an employer must pay all due wages within 2 working days of the employee's departure. That 48-hour legal deadline applies unilaterally. Whether the employee resigns, is dismissed, or terminated, there are no exceptions for extended handover clearances. Finance teams are simultaneously hit with a second distinct offboarding deadline for gratuity. The Social Security Code mandates that gratuity must be calculated and dispersed strictly within 30 days of the employee's exit. This snapshot table categorizes these tight deadlines as highest priority event-based compliances. Failing to meet these precise timelines instantly triggers compliance mechanisms like improvement notices from the appointed inspector-cum-facilitator. The practice of holding a final settlement hostage pending internal IT or manager clearance is now a direct, easily provable violation of federal law. The true impact of these codes becomes clear when you connect the rules of structuring directly to the deadlines of offboarding. The financial threat cascades through working capital in 4 steps. Because the 50% rule mathematically forces a higher basic wage, the baseline principle for gratuity is permanently higher. That inflated gratuity sum then crashes into the uncompromising 30-day legal payout deadline. For a Pvt Ltd experiencing high employee churn or executing layoffs, these simultaneous mandates will drain available liquidity faster than traditional forecasting models account for. To survive this, employers must immediately audit their current CTC structures, testing them against their specific state zone and skill matrices to project actual baseline costs. Next, operations teams must completely redesign their internal clearance pipelines to guarantee that all final payouts clear within that 48-hour mandate. The new wage code replaces paperwork with strict algorithmic enforcement. It dictates the financial physics, the liquidity requirements, and the operational speed required to legally run a business in India today.